review it later.
Okay. Now, we have this question, my brother. This is a balance sheet, this one. And this guy known as GMW are in a partnership. They are trying to dissolve. In this process of dissolving the partnership, we are going to sell all these assets. The procedure is first take all the assets except cash and debit them to an account that is known as realization account. And that is what we have done here. These assets, we have taken all of them except cash and debited to realization account. Immediately you make that decision that you are going to dissolve the business, you debit those assets to realization account. Are we together?
Yes.
Now, the next step is you sell these assets. You start selling them one by one. When you receive money on sale of an asset, you debit bank account. It's obvious when you receive money, you debit bank account. So you are debiting bank account. Now, after you have debited bank account, you credit this account known as realization account.
Realization account.
The next one is SODIA. You receive the money and you'll debit bank account to receive the money, credit realization account. Are we together? So that is basically what you have done. Basically what you have done. No sense.
Okay, I am together.
Okay. Now, someone is speaking. All right. Someone had given me a signal that they were progressing on well. Now, come here and do this. You are told they are silent about the creditors. What do you expect of the creditors? The creditors will be paid. So when we are paying creditors, I don't want to open the creditors account, but I know I'll debit the creditors account. But hey, if these things flow so naturally in me, and the reason is as simple as this. I understand the basis of accounting debit and credit. As long as I can see debit and credit, then at whatever level of accounting, whatever I'm dealing with is straightforward, as long as I'm able to identify what to debit and what to credit. And if you understand some basics, like if it is a creditor that you have to pay, you debit that creditor, you credit bank. It is taught when you are starting accounting. Looks tedious, looks boring, and when people are not keen at it, they like to rush into the core of accounting, which is preparing those financial statements. But for us who have the basics of double entry, this thing just fits in place. So we are going to credit this account and write here that these are payables that we are settling. We must assume that they are settled at book value. If they don't tell you otherwise, then you cannot expect that they pay these creditors lesser money. So you can see the payables is 112,000. So I come to my bank account and write here payables 112,000. All right. Now, I'll have to come back to my realization account and attempt to balance it off. Come back to realization account, attempt to balance it off. Aha. What is the balancing figure of this realization account? Siniwafanyie. Ona. 584. And this other side? 392. So, sum, sorry, equals to sum So my balancing figure ndio hiyo 192. So this 192, I'm going to share it between G, W, and K. G, M, G, M, and then W. Did you get same value I'm getting, 192? Give me a shout out. Nakitare.
Yes, I got 192.
Now, this 192,
Yes, you got 192.
we'll have to remind ourselves that these guys were sharing profits and losses in the ratio 3:2:1. So when we share these 192 in the ratio 3:2:1, what we get? 3 takes how much?
G takes 96,000.
He takes 96,000. Murray takes what? In the ratio 3:2:1. Murray takes
64,000.
64,000. And this other fella, Wilkins?
32.
Huh?
32,000.
32. Can I have only my students in this class? So from that entry, you can see this is taking the credit side. So we obviously know that it should come to the debit side of the capital accounts. So this is known as loss on a realization. And how do we know that it is a loss? Because the value of these items is much more than the amount that is realized. This, when you realized, what you realized gives you a deficiency of 192. So these guys on sale of these assets, they are actually losing. So we are going to have 96,000 here and have 64 and 32. Now, we are already informed that this guy here, known as Wilkins, is insolvent. Therefore, we must start being careful with him. You know, in the other case, when we reach this stage, we did exactly what we have done. When we did this, we ran to the bank account and balanced our bank account. But we need to check this guy known as Wilken. How is he behaving in his account? Now let us look at this. He has a negative current account balance of 56. And now on realization, we have added onto his loss and we have added 32. So looking at this, he has 56 plus 32. And on the other side, he has 80. 56 and 82 looks like what?
88.
Yeah?
88.
88,000. So he's going to have 88,000. All right? Now, this 88,000 means that we are going to have a balancing figure here of 8,000. The balancing figure of this guy is 8,000. Do you understand?
Yes.
Now, this guy in the partnership has a negative of this 8,000. In other words, we should be asking him, you know, in the solution of a partnership, what should happen is, because you are closing a business whereby you had contributed capital, on the solution, we should pay you money. You come out of the partnership with money. But this guy is operating in negative. What does that mean? What does that mean? He has negative. What does that mean? If those who are positive should carry money from the partnership, then that one that has negative, what is he supposed to do? Any idea? She's opposite. Those who are positive are supposed to be paid money by the partnership. We're talking a pesa for partnership. This one who has negative should now bring money into the partnership. We should be asking this guy to go and bring money so that we debit to the bank account. This 8,000, we should be asking him to go to his home and bring it. But we have been told that this guy is insolvent. Meaning, if we send him back to bring money, he'll not have money. He doesn't have. So what happens is now that he's deficient and is insolvent at the same time, this insolvency shall be borne by the solvent partners. Shall be borne by the solvent partners. And it is borne by the solvent partners. These are that to Garner and Murray in their last agreed profit sharing ratio. Not profit sharing ratio, the capital ratio. Capital ratio is 240 is to 160. 240 is to 160. Solve it. Becomes what? $240 is to 160. 8 is the common denominator. What do we call LCM? Or least common multiple is 8. So 24, 8 gets into 24 3 times, gets to 160 2 times, twice rather. So the ratio of the capital here is 3 is to 2. So these solvent partners are going to share these two solvent partners are going to share the insolvency of the insolvent partner. In their last capital agreed, in their last agreed, why don't they use the profit sharing ratio? The profit sharing ratio was between the 3 partners. But now one of the partners is out of question. So we don't follow the profit sharing ratio. Now we follow the capital ratio that was in the partnership before this partner became insolvent. So it is this 3:2. So 8,000 we share in that ratio. Three to two. Somebody? Somebody?
4,800 and 3,200.
So this one is going to take 4,800 and this other guy will take 3,200. So the deficiency of 8,000 has been shared 4,800 and 3,200. They have covered this guy. Now, what will happen after this is we'll go ahead and now balance our capital accounts. Let's balance our capital accounts. If you check W, is already balanced. That is 88. And on this other side, we have 88. For the rest of the partners, let's get the balances. The other two partners, let's balance. One side you have 280, and on this other side you have 100, 800. So let's get the balancing figure there. And this other partner, we also get the balancing figure. Please, let me have this quickly.
$179, 200 for G.
For G,
179,
179, 200.
200.
And for Murray,
128,
128, 800.
128, 800.
800.
800. I'm going to fix these figures. I'm going to write here bank. These guys need to be paid their money, bank. And I'll bring it here to my bank account. Do you remember? So capital accounts, G and W. G and M, Garner and Murray. So one you told me is 179, 200. And the other one is 128, 800. Okay. I'm going to bring them to bank account. And let me see whether my bank will balance. 420 on that side. And on this side, 420. Yeah. My bank account will balance and I've sorted out this partnership. Now you clear with this. Get the totals here. 420,000. If you are left with some balance in your bank account, know that you have not finished the question. Repeat again. Confirm that we are together. I'm waiting for you to give me a thumbs up so that we can go to the next item. Are we together?
Yes.
Yes.
Now that is known as a dissolution of a partnership. All right. Want to move on to the next item on the agenda. Want to believe wherever you are safe. You are in your house. So even if we get to midnight, I want to believe that it shall be okay. I'm worried we are struggling to clear topic 1 now, and then get to another one and another one. I'll be happy if by end of this June we are going to clear 2 major topics. Not this one. If we clear consolidation and clear another one, and clear branch accounts. If we can do that in June, then the small topics, we'll be sure to deal with them in the month of July. Those ones you can be doing one each day. Now, we want to talk about conversion of a partnership into a limited liability company. Which screen are you watching? Are you on the Word screen? Are you seeing a Word document?
Yes.
Yes.
Ama isikue hatujui tofauti. Okay. Now, conversion of a partnership into a limited liability company, most of the partnerships will go this route. If you meet over there, start a business, you may start as friends so informally, and then realize that you need to register a partnership. Then in due course of time, realize that a partnership is not a good idea. Actually, businesses rarely operate as partnerships, except where the law so requires that business be operated in form of a partnership. Some businesses like legal practice and accounting practice, when you're operating as an auditor, you cannot operate as a limited liability company. You must operate as an individual or as a partnership. And why we do this in auditors, let me educate you a little bit, why audit firm must be run as partnerships, and we must know the individuals who are behind this partnership, is because in audit, the profession deals with expressing opinion. At the end of the audit, what you get is an opinion. To express an opinion and say, this is what you think of the books of accounts that have been made by that company, you must have a natural mind to express an opinion. A company cannot have an opinion. And should this go so, we'll look for that person who gave the opinion and told us this company is sound. Okay? There must be a mind that processes that idea. And therefore, we'll get down to that person and ask the basis which they gave that, and go ahead, and if you want to prosecute that person, do so. So, except in those cases whereby the law is so specific that you have to operate as a partnership, partnerships would be business relationships that are not long-lived. When people form partnerships, after some while, they'll desire to convert that partnership into a limited liability company. One major thing with this limited liability is basically the benefits of that word, limited liability. What do we mean when we say the liability of a company is limited? What is limited here? What do we mean by limited liability? Do we know? Why do we say a company is limited liability? That means I'm waiting for someone who knows to tell us. Someone, please. I'm JSK what? I'm J Form Company. Now, limited
Mwalimu, let
liability.
me try.
Yes.
I think for limited liability,
Mhm.
the owners of the company,
Mm.
they cannot be liable for the liabilities of the company.
You are not liable for the liabilities of the company. But there's the word limited. Limited. You are true, you are not liable for the liabilities, but there's the word limited. Your liability to that company is limited. What does that mean? It means that your liability is limited to your capital contribution. Okay? Is limited to your capital what? Contribution. So if you have 10 million shillings, you as a person in a Kitare, you decide to join a company and buy shares worth 1 million shillings, you have been left with 9. Should things go wrong in that company, you can lose this 1 million that you put in the company. These 9 that you were left with, now you as a person, you should not lose because you and the company are separate entities. Unless in a case whereby we have to lift the veil of incorporation and establish wrongdoing by you as a director of this company. Probably you had siphoned funds from that company and it's established, you had jeopardized the interests of the creditors and so forth. And now we establish because of this reason, we have to lift that thing that is known as the veil of incorporation and now charge you now as a person. But under normal circumstances, your liability is limited. Because of this benefit of limited liability, it's advantageous to operate a company. So when enough fit is formed as a partnership, they know that it is in the way of becoming a company. Now, this is the accounting part of it. What will happen is you transfer the assets, you transfer the liabilities of this partnership, you transfer them into the company. When you have done this, the company now assumes those assets, rather takes over those assets and assumes the liabilities. These shareholders, rather these partners who had contributed capital, will be compensated by being given shares into the company. So what happens as far as accounting entries are concerned? The first thing is with the assets that are taken over by the company, we'll open an account, call it realization account, and we'll debit that realization account and credit the assets account. All this we do are book values. The liabilities that are taken over will debit liabilities account and credit realization account. With the agreed purchase price, because there'll be an offer, will debit purchasers account and credit realization account. If there are some realization expenses, we'll debit realization account and credit bank account if this is made by the partnership. Okay? With liabilities not taken over, It means that they have to be paid. We'll debit liability account and credit cash account. Now, any balance that is left in the liability account is either gain or loss. This liability that is not taken over, but is paid by the partners before they close the partnership, is paid. Then we debit. We'll actually have to consider it as a loss or gain on realization. If it is not taken over at book value, it means that there'll be a gain or a loss in that liability. To close the realization account, we debit the realization account and credit partners' capital accounts if it is a gain. The opposite of this will happen if it is a loss. Okay? If it is a loss, will be debiting the partners' capital accounts and crediting realization account. Now, to record a receipt of the purchase consideration, if it is in cash, you will debit bank or cash account and credit the purchaser's account. If it is in form of shares or debentures issued, will debit capital accounts and credit the purchaser's account. If it is in form of cash or some other form. Now, the remaining balances in the capital accounts will be closed by withdrawal or payment of cash. They'll be paid and we close off the capital accounts. Now, we're in the question that is known as Buddy and Abdi. We're in this question that is known as Buddy and Abdi. They had assets and liabilities as given this illustration. Okay? These are the assets and liabilities. Are we moving too fast? Now, the capital accounts are given here. I think forgot to do the usual thing. We normally remove these borders so that does not look so ugly with many lines. Okay. Now, what else are we told? These partners agreed to form a partnership known as DIBA. Are you still here? And these were to acquire all assets except cash at an agreed price of 200 million. The purchase consideration was settled by issuance of shares of 150 and a check of 50 million. DIBA was to flow shares worth 500 million, 350 being subscribed and paid for in full, and these are outsiders. Now, the assets were revalued at these amounts, and you are told to prepare closing entries in the books of Abdi and Buddy, and then the opening statement of financial position of DIBA, this new company. What are we supposed to do? What are we supposed to do? Assets taken over by the company, we are going to debit realization account and credit the assets account. Liabilities taken over, this is what we do. Okay. So we are in the assets here. I want us to get ready and prepare this account. I believe that you can give me 30 more minutes so that we close this topic. Can we?
Yes.
As usual, I'm transferring these to Excel. First thing that happens, now let me show you the opening balances of your capital accounts. 100 and then 80. This one has 100. And this other one has 80. And then current accounts. This one has 15. Abdi and Badi has 5. All right. Then next is we need to open realization account and bank account. Now, this second one is our bank account. All right. In our realization account, we are told to debit it with the book values of the assets. So these are the assets, except cash. So we'll have land, motor vehicles, furniture and fittings. Land, motor vehicles, furniture and fittings, debtors, inventory, and then debtors. All right. Okay. So the assets values 120, 40, 15, 120. What did I see? 40, 15, 15. What about debtors? What they tell us about debtors? You are told okay, debtors is 25. 15 and then 25 for debtors. Remember it's book value, so 25 for debtors. Okay. Now, these guys, DIBA is going to acquire all assets except cash at an agreed price of 200. Then the purchase consideration of 200 shall be paid by issuance of checks, shares worth 150 million and a check for 50 million. So let me show you how we are going to deal with this issue of purchase consideration. So we are going to say here purchase of business account, and these guys are giving us they are giving us a check worth 150 million. They are doing it at a consideration of 200 million. At a consideration of 200 million. So we are giving away our assets except cash at 200 million. Okay. Then in the bank account, we'll have our balance BD. In the bank account, look, our bank has this balance of 10. So bank has a balance of 10 million. All right. Our balance has a balance of 10 million. Now, How do we account for these 200 million that we are given? These 200 million, let me show you. We'll open an account here that is known as purchase of business account. Or we can call it DBUS account. These guys that are the company that is now buying us will open an account here like this. Okay. What are they offering? They are offering on realization. Sorry. Realization. They are offering us 200 million. Like this. How are they giving us this amount? This one, purchase of business, they are giving us in cash, they are giving a check, bank, or rather, purchase of business. In the purchase of business, we are collecting a check. Watch here. They paid a check of 50 million. I hope when I switch from one sheet to another, you are also able to see. So they are doing a check of 50 million. All right. What happens? We come here and say bank. 50 million. What happens to the remaining amount? What happens to the remaining amount? Look. They are issuing shares for 150 and 50 to make it 200 million. 50 is the cash that they are going to give us. Or in the question, which is in the Word document that I gave you, they indicated that these guys were sharing profits and losses equally. So what happens? We are going to have shares which go to capital account. And this 150 will be shared between the two partners, A and B. They are going to share, they are going to share the amount that makes 75 and 75 equally to make it 150. So they were receiving shares, the odd shareholders in this partnership, they are receiving shares for 75. So we can come here and say that they have been issued with shares to compensate them because they are giving away their partnership for 75 and 75. Now, we have not finished. When we receive this amount, we have to pay our creditors. They did not carry with them the creditors. So they had to pay their creditors. Let us see what we have with the creditors. The creditors are here, 25 million. So we are going to use this money that we have to pay the payables. They are here. the payables of 25. All right, of 25. What happens to the difference of the cash that we have? We'll come back to our realization account. Let me see. The total here in our this is 215, eh? 215. And there's 200 on this other side, 215. There's 200 on this other side. So the balancing figure here is 15. Now, this 15 is loss on realization. And therefore, it shall be for A and B. There's a realization loss of 7.5, 7.5. Do you get that? There's a realization loss. Oh, we need to label this one is A and B. A and B. So the realization loss is 7.5, 7.5, 7.5. Now, when we have done this, come back to the bank account. Come back to the bank account. Come back to the bank account. And in the bank account, we have a balance of 60 on one side and the other one 25. There's a balancing figure. Now, in that balancing figure, we also do the same and balance these capital accounts. Let us balance the capital accounts, please. What are the balancing figures? Here you have 115. What about this other side? We have this 115 minus that, minus this. 32.5. Let me see what we have on this side. We have this 85 minus 75 minus. So I'm going to have capital accounts. Now I'm settling the dues that are for these guys. A, A and B. So one is 32.5 and the other one is 2.5. Let me see whether I've paid these guys in full. That side has 60 and this one has 60. So I'm happy. This is the payment, the final payment to the partners. They are paid in full. Now, we like to proceed and prepare the statement of financial position for this company that has been formed. All right? Now, we do in the books of the company. We are going to open an account in the books of the company. And we call the first account business purchase account. Okay. Now, how much did we offer our purchase consideration? To purchase this new business, how much did the company offer?
200.
200. Thank you very much. Is 200. What did they get in return? They got assets. And the assets that they got, they did not get them at the book values, except debtors. They got land, motor vehicles, buildings, inventory, and debtors. So what did they get in return? They got now land at 150. They got, next is motor vehicles at 35. They got, we are told, furniture and fittings. What are they saying? At 10. Inventory. They got this inventory at, what did they tell us? They got it at 13. And then they took the debtors at the book value. What is the book value of these debtors? In the balance sheet where we are coming from, the debtors are here at a value of 25. So they were taken over at 25. So let us try to do summation here. 233 and here we have 200. So there's a balancing figure here because the total here is 233. There's a balancing figure of 33, which is known as a capital reserve. This is a capital reserve, is gain on purchase. In purchasing this company, they are offering 200 million to get 233. So they are, sorry, they are gaining. Mnasikia? They are gaining. Suppose the balancing figure was on this other side. Like here we have 250 and on this other side you have 233. What you do, of course, the balancing figure, if it was on this point.
Loss on purchases.
Okay. No, it's not loss. I tell you the name. If it was on this other side, it is known as goodwill. And most cases, it will be goodwill. If you get it on this other side, you will have an additional asset in your balance sheet, and that additional asset is known as goodwill. Now, let me open an account here. And call it purchase consideration. I'll say this is a business purchase. We are purchasing the business as 200 million. But how are we settling this 200 million? Huh? How are we settling this 200
With the
million?
check and the shares.
So, bank is 5 million. No, bank is 50 million. Yeah?
Yes,
50. And then shares,
150.
150. Okay. Share capital account. Now, share capital account, there's this one that is part of purchase consideration. Which amounts to purchase consideration, 150. And then they ask, now let me take you here. They are raising the floated shares for 500 million. The 350 million now are paid for. They ask more people to come into their company and pay for shares. So there's this 350 that people now paid for bank, 350. So that the balance of their share capital balance carried down is 500 million. It looks like that. Finally, our bank account. Our bank account will look like this. Watch this. Let me not open it, but just see that our bank account will be debited with this 350. Okay? Our bank account will be debited with this 350 that we are collecting on issuance of shares. This one that we are collecting on issuance of shares. Then it will be credited with the 50 that we paid to the partners of A and B. When we had a partnership, there's money that was paid to them. In the bank account of the partnership, they were paid 50. So the company now is the one that is paying. The partnership is receiving, the company is paying. So when we open the bank account, please open bank account. Ama nifanye mara moja. Bank account. We are going to say this in the bank account. Share capital. Unaona hii 350 million. And then this purchase. Purchase consideration that we had to pay 50 million. So the balance carried down in our bank account, balance carried down in our bank account becomes 300 million. Becomes 300 million. And now we are ready to do our statement of financial position. Statement of financial position. We do it in 2 minutes, you'll be surprised. Statement of financial position is the balance sheet. Let me show you how my balance sheet will look like. I not do it in the standard format, just in interest of time. I do this. Those are my assets. In addition to those assets, I have this bank. This one, 300. And therefore, my total assets will amount to that 533. Capital and liabilities. Ordinary share capital. Ordinary share capital, you remember our share capital, this one. We raised share capital of 500. And then in addition to this share capital, I have this capital reserve of 33. You remember, I bargained on acquisition and I made a gain by buying my assets at a price which is lower than the market price. So I made a gain of 33. And now you can see that my balance sheet will balance and my balancing figure becomes again 533. Friends, you can ask questions.